Hi, this is Bob Iaccino, Chief Market Strategist and the Head of Research at TrendyTrade.com. It is July 10th. Here to give you a little bit of a weekend preview for most of the markets, at least the markets that are moving. So for example, the dollar index right now is slightly higher, not moving at this point. It's the type of level that I would consider to be unchanged. And you wouldn't expect the dollar or yields for that matter, which reached multi-week highs in the US, multi-month highs in Germany and France last week. You wouldn't expect a lot of movement considering what I see is the most important thing going on this week, and that's Janet Yellen's semi-annual testimony to the U.S. Congress. Now, this used to be called Humphrey Hawkins back when Alan Greenspan was doing it. It is a legislated testimony. She has to do it. Prior to that, they released the Fed's semi-annual report on the economy. That came out on Wednesday. So there were some really interesting things that came out that she's going to be measured against when she speaks before the House on Wednesday and the Senate on Thursday. One of those lines is that it was appropriate for further gradual rate hikes, given where the economy is, and calling money market policy still accommodative. So when you look at it in that vein, considering that this report was accumulated before Friday's non-farm payrolls, you want to watch in the question and answer that starts on Wednesday and continues before the Senate on Thursday as to whether she could contradict any of that, given the strong payrolls number that we saw on Friday. That 222,000 was a good number, beat by about 54,000 or so versus the estimates. And the 4.4 unemployment rate rise was not a big deal because labor force participation also bumped up to kind of counterbalance that. The problem with the jobs number on Friday was the wage component and the hours worked. 2.5% wage growth over a year is not enough to generate 2% inflation. It doesn't go up on a tick-for-tick basis. For example, in heavy civil engineering construction, the input cost of labor is only about 8%. Okay, now that doesn't include administrative, healthcare, executive salaries, but it's not going to get it up to a level where 2.5% wage growth is going to equal 2% inflation. So those numbers have to pump up a little bit. We have to see if Janet Yellen contradicts that. Right now, the CME FED Watch Tool is putting this next rate hike, which is the only one it's really measuring out, at sometime between September and December, more likely in December. Now, we've got some interesting earnings coming out this week. We've got Pepsi. We've also got Marks & Spencer's and Burberry's, which will give us kind of a gauge as to what the high-end retail is doing. But more important than that, because financials were the high-performing sector on Friday after the non-farm payrolls number and after the increase in rates that we saw globally, we've got JP Morgan, PNC Bank, Wells Fargo, and Citi all coming out Friday, most before the open. So that's really going to drive the market. So the big market movement in the equities especially, and potentially the currencies because of the dollar effect of the Fed, is not likely to happen before Wednesday or Thursday. What could move is crude oil and the metals. Metals right now, after falling last week, are pretty stable. Precious metals especially, copper at about 264, silver at about 1655. But crude oil is rallying back a little bit, up about 1% as I talk to you now. The interesting thing about crude oil is this may be the new normal. To me, crude oil seems capped at about $47. The 1% rally that we're getting right now to the $44.50 level is off of the idea that Libya and Nigeria are going to be brought into the fold and cut production. Right now, those two countries have an exemption. But that's not all the increase in production. Last month, OPEC exported 450,000 barrels more than they were estimated to. 380,000 of that is Libya and Nigeria. So where's the remaining 70,000 coming from? There is some cheating going on. Most likely it's Iraq, but the production cuts are not working the way OPEC wanted them to do in terms of it moving prices higher. The non-OPEC producers seem to be complying as of right now. So watch crude oil again. I think it's capped at about $47, but we did have significant draws last week Wednesday, or rather Thursday with the holiday. The EIA figures came out a bit later. We had good draws out of crude oil and out of gasoline, and the rig counts jumped up again by 12 on Friday. The Baker Hughes rig count in terms of U.S. production, also U.S. production jumped. So combining all that in, seems to me like crude oil's capped. This is Bob Iaccino giving you kind of an early week preview for TrendyTrade.com.